there are two things I would tell people to watch out for. The first thing I would tell people to watch out for is what's known as an inversion of the yield curve, which basically is an environment where the yield or the interest rate, if you want to think about it that way, on short-term interest-bearing securities, especially treasury instruments, are higher than longer term, because that's usually a negative signal, because it means the Fed has probably gone too far too quickly. And so as a consequence of that, usually it's a sign in advance that we're going to start to see a recession. Basically, cutting through a lot of the technicalities about it, it means that the market thinks the outlook for the future is more dour than the outlook for the present, which is why the yield is lower in the future than it is today. Second thing I would tell people to watch out for, really, and I think this is a good way to think about it, is pay attention to the labor market, because there are a lot of things in the economy that might or might not be telling you exactly what's going on. But the labor market it's not a perfect real-time indicator, but it's a pretty good, actually I'd say leading indicator. It's a pretty good leading indicator. If there is going to be trouble in the economy, you will almost always see it manifest in the labor market before you see it show up in metrics that most people don't really understand in finite detail, like GDP, something like that.